Today's conversation is sponsored by the Billy Keels Advisory Program. If you want to learn more about how to make your 9-to-5 optional, just go to billykeels.com/advising. Once again, that's billykeels.com/advising.
If everything that can go wrong does go wrong, you have almost a backstop in that you own a hard asset that has value. And even in a liquidation is sold, you are going to be able to recoup a majority, if not all, of your invested capital.
You're listening to the Going Long podcast with Billy Keels, the #1 podcast for long-distance real asset investing.
Welcome to the Going Long podcast. We're back once again to continue to help to educate you so you feel much more comfortable as well as confident investing beyond your backyard. I'm your host, Billy Keels, and guess what? We got another fantastic conversation on tap today, and I really am looking forward to getting you to the conversation. One of the things that I would like to do first and foremost is thank you for continuing to listen, continuing to share. I've got a lot of really cool things that are on their way to you. So if you've been leaving your honest written reviews as well as ratings, we really appreciate that. Thank you so much. For those of you who continue to tag us across Instagram, across LinkedIn, it's amazing because you're helping to bring more people to the Going Long family. Thank you so much for that. And also too, if you want to check out any of the previous episodes, just go to billykeels.com/podcast and you'll be able to check out every single podcast we've ever done, well over 300 at this point in time. You can check out the transcripts, the video, the audio. Once again, it's billykeels.com/podcast. So today we're going to get into a conversation where you're going to be able to really take advantage of a strong, deep finance background and being able to combine that with a number of different assets, or let me say that slower, a number of different assets. Specifically, we're going to look at commercial real estate. We even talk about some things around mines, and we talk about tugboats, believe it or not. Yes, I did say tugboats. And we're going to get to that conversation that I had with the founder and general partner of Redwood Capital Advisors, Ben Spiegel. And we're going to get to that conversation just after this. So if you want to understand how bringing a very strong finance acumen combined with the power of commercial real estate and how that can boost your long distance investing success, then guess what? Today's the conversation you're going to want to listen to until the very last word. Yes, I did say the very last word. You know why? Because today's guest not only started his career as an analyst in the financial services industry. That's what I call it, at least. I mean, he probably will give you a lot more detail because he lived in that world. He also then later on specialized later in his career on kind of a special situation opportunities when he was, in part of a credit hedge fund. Definitely want to hear more about that. And today he is the founder as well as the general partner of Redwood Capital Advisor. It gives me great pleasure to welcome to today's conversation, Mr. Ben Spiegel. Ben, welcome to the show, man.
Thank you so much for having me. I really appreciate it.
Yeah, I'm looking forward to it, man. I appreciated our pre-conversation, and I am absolutely convinced that the Going Long family today is going to take massive value out of today's conversation. By the way, Ben, no pressure whatsoever.
I hope so.
We like to have fun here. Actually, we like to have so much fun that I'm going to ask you 5 questions, sort of like not really just 5 questions. I'm going to ask you a lot more than that. But in the beginning, I'm going to ask you 2. In the end, I'm going to ask you 3. And in the middle, well, just depends on kind of how the flow of the conversation goes. But I want us to get started. And that's going to really get started with question number 1 is help us understand, where is it that you call home in the U.S.?
Yeah, so I currently live in Greenwich, Connecticut, which is a suburb of Manhattan. It's about 45 minutes away. I have lived here for about 5 years. And I've been around this area most of my life. I grew up in Westchester County, which is just neighboring Greenwich to the west. Always around the suburbs of Manhattan is where I've called home since I was born.
All right. Fantastic. Sounds great. So Greenwich. And, the other thing I really would love for you to share with this, because I just love positivity so much, man. Help us understand, what is the most positive thing that has happened to, or let's call it for you, in the last 24 hours?
Yeah, so surprisingly enough, as I'll get into later on the show, my niche is the outdoor hospitality industry or building luxury RV resorts. And within the last 24 hours, I got introduced to a very qualified and impressive developer and operator of an RV resort, but he has a piece of land, but he doesn't have the financial wherewithal to build. So basically, he's looking for a financial sponsor to come in, partner with him, give him the necessary capital to help him start construction, which the project is already shovel ready to go. So it's very unique to find a piece of land that's already has zoning and all the building permits and is shovel ready and is already owned by a competent developer with a track record and is just looking for some financial resources to get the job started. So I'm going down there on Friday to check it out.
Oh, fantastic, man. Well, that's always nice when you have opportunities where you can collaborate and continue to help others and add some value where that's possible. So appreciate you sharing that with us. And the other thing has been the Going Long family knows this about me already. Like I am a recovering perfectionist because I am aware of the fact that I have these perfectionist tendencies, and I'm working on constantly like being more realistic because sometimes you can't do everything you want to do. And sometimes I try to do things that are almost impossible, like tell your entire backstory. And I think I tried to do that in like a second and a half. You've done too much, you've made too much impact. So it was almost impossible for me to be able to like tell your whole backstory. Plus, I'm not you. So here's the thing. I would love for you to share your backstory in your own words, Ben. And if you can, along the way, can you talk about some of the major decisions that you've made to get to this point in your journey? And then we'll see where you and I take the conversation from there. How's that sound?
Absolutely. I'll start right
All
away.
right. Over
So,
to you, man.
I graduated Syracuse University in 2011. I was lucky enough to go right to the investment banking arena. I was at Barclays Capital for just under a year. With aggressive networking and interviewing, I was able to make the move over to the buy side where I joined Cedarview Capital, which is a small credit opportunities hedge fund specializing in high yield leverage loans, high yield bonds, primarily in the new issuance market. I was there for about a year when I met a man by the name of Dov Gertzelen, who's the portfolio manager of a hedge fund called DG Capital. He was managing about 250 million. He was 28 years old, young, ambitious, looking to grow exponentially. I immediately fell in love with his strategy. And after interviewing for a couple rounds, I made the move to DG Capital. They focused on special situations as well, but there I got much more involved in stressed and distressed situations, more bankruptcy and restructuring, and much more complex, illiquid, types of situations that require a lot of legal know-how and a lot of collaboration and just a lot about potential for a lot of return. So if I was fortunate enough that when I moved to DG Capital, this was back in like 2014, I started doing pretty well at a young age. So I was prudent with my bonus money, and every year I had a rule that I would take at least half of my bonus and buy a small building. So back then, you could buy 4 1 bedrooms over in Delhi and in a suburb of New York City for 350,000. Put 80 grand down, take out 270,000 dollar loan, and that's about it. So over the next couple of years, I accumulated 5 or 6 of those. When I got a call from Signature Bank that they were looking to offload a very large non-performing loan. Long story short, I ended up leaving the buy side, purchasing that note and taking it through the bankruptcy process, and then restructuring the buildings by doing something I like to call Section 8 arbitrage. And about 2 years late after I took the buildings out of bankruptcy, I sold it for a very large profit and have basically been in the real estate special situation space ever since. And most recently, about a year and a half ago, I formed a novel joint venture to really start primarily focusing on the outdoor hospitality industry, or luxury RV resorts, due to, in my opinion, one of probably the largest supply demand imbalance in anywhere, in any market, in any industry right now. So, just to finish off, currently I'm in the process of forming a private REIT and raising capital to build, with a mission of building 1,500 to 2,000 pads across Louisiana, Alabama, and Mississippi over the next 24 to 36 months.
Cool. So 24 to 36 months, and then another, you said 1,500 to 2,000 pads?
Yeah, so basically, for an institution to have interest in buying a resort, their minimum is usually about 300. So we like to target 300 pads per location,
Mhm.
and we're hoping to scale between 5 and 8 locations. And then on top of that, of course, we're looking to also franchise the concept on a nationwide basis to exponentially grow simultaneously, not only through through greenfield new builds.
Okay, fantastic. So it sounds like there's some growth plans in the future. There's a couple things, right? Because you mentioned on a couple occasions. I just want to make sure as we talk about this that the Going Long family is we're on the staying on the same page. Because and I even talked about it in the very beginning. When you talk about special situation opportunities, what would that mean for the layperson? Because I think you and I know what it means, but just to make sure we don't leave anybody behind. And you've kind of talked about it, but just to, if you're wondering, well, what these guys are keep talking about special situation, what does that exactly mean? Talk to us.
Yeah, absolutely. So a special situation is really any kind of investment opportunity that it has something that's unique about it, whether it's off the run, niche, contrarian in that it's out of favor, or you have some type of competitive advantage that enables you to have an asymmetric return profile. And I like to call myself asset agnostic. It doesn't matter if it's in real estate, or you're buying a coal mine, or you're buying, dry barges and tugboats and triple net leasing them out to third party operators that operate on the Mississippi and Ohio rivers. It's really any situation where you have almost an unfair competitive advantage, where you have a much better chance of making outsized returns on a risk adjusted basis.
Okay, fantastic. So appreciate that. So really, it just means, hey, listen, this is something that's not cookie cutter. It's not something that happens like you may see every single day. There is an opportunity that exists, and being able to, as you talked about, on a risk adjusted basis, could provide you with an outsized return. At the same time, it's one of those things that you have to hold it with kid gloves, because the same way that it could give you an outsized return, there's also the special situation could be, well, a potential downside as well. So just to kind of keep things open, would that be a fair assessment for the layperson too?
Absolutely. Obviously, there's a little bit more risk associated with it, but if you're able to really find, in my opinion, a real special situation, the downside is much more controlled than in a normal investment scenario. Some type of hedge or protection built in. It's not buying a Class C multifamily and lightly renovating it, raising the rents, refinancing, and then selling a couple of years later. It's the opposite of something like along those lines.
Yeah, would it be fair to say that it would be important to make sure that you either have the expertise, or you are working with someone that has the expertise on the front end of something like that? The special situations that we're calling in that will provide some of the downside protection.
Absolutely. I think it's very important to stress that you need to be investing with, or at least partnering or getting guidance from someone that has a quantifiable track record of creating value in that specific niche. And just to really control your downside, because a lot of times these situations are highly illiquid. There's not a lot of secondary trading activity or even bids for the assets. So you really have to be comfortable owning it for an extended period of time in a lot of cases. So you really, I would stress approaching everything with caution and always partnering or investing with someone who has a quantifiable track record of doing it numerous times with success.
Fantastic. Well, appreciate you recapping that for us. And also, too, one of the questions that really I was interested in, right? Because I really appreciated the strategy that you talked about. If I heard you correctly, you said when you would get your bonus checks, because a lot of people here that get a lot of bonus checks, pretty big bonus checks usually. And I say big bonus checks like 6 digits and above. When you're getting those types of bonus checks and you decided to put 50%, I think that's what you said, 50% into 50 assets. Talk to us a little bit about how you came up with that strategy. I know strategy is something that's important. You talked about the DG Capital or DJ. I'm probably not saying that correctly, but you fell in love with that strategy. And then I hear you talking about your strategy to take 50% of your bonus check and put it in some other type of assets. Unpack that for us a little bit.
Yeah, so I've always had an entrepreneurial way of thinking, and just kind of not really going with the grain would have been putting 100% of it just back rolling it into the fund and being fully invested in the fund like almost every other employee did. But I always, even in college, I always would research small investment properties, on MLS or the public listing service, and I always noticed that I was attracted to hard assets where there was really a collateral value to protect your downside, and with a current income component, and accompanied with obviously the amazing tax benefits of depreciation and net operating loss carry forwards. And when you combined all those, I just felt would be almost irresponsible not to allocate at least a decent amount of my earnings towards the real estate asset class. And obviously, doing a lot of reading, at college and post college, it was very clear that the vast majority of millionaires made their wealth through real estate more so than any other way, and basically that. Real estate has been and will continue to be the greatest source of wealth creation for mankind. So I just wanted to start getting exposure. I wanted to get the income to supplement my salary. Because also another thing is when you work in the buy side, your salary isn't always the greatest. It's the bonus that you really look forward to. You could be making, your bonus could be 5-6x your salary. So basically, I always wanted to, from a young age of working there, I wanted to start generating supplemental income to supplement my space salary that was never as high as I obviously wanted it to be. But that's just how the industry works.
Okay. And that's really helpful. So it's this is a strategy. This is something that you really knew that you wanted to get involved in. I trust you're enjoying today's conversation. If you want to find out more about how to make your 9 to 5 optional, just go to billykeels.com/advising. Once again, that's billykeels.com/advising. Now back to the conversation. Was the goal for you to be able to create some type of is it just a financial return? Is it some other type of goal that you set for yourself when you decided to, because there's the different benefits that you talked about, right? So you're able to have that cash flow today. You're able to have the appreciation in the future, potentially. You have the strong tax benefits. What was the end goal, though, for you, aside from the accumulation of assets?
So when I first started, I didn't really know what I was doing, to be honest, 100% honest.
Yeah.
I just thought that it represented, that if I could find a good deal and buy something at a high cap rate relative to what I believed the market was, and could borrow at a low rate and generate a strong free cash flow yield, that it was probably worth doing. And that it was really, I didn't think too far ahead at that point. But as the years went on and I started to make more, what I would call proprietary relationships with banks and brokers that would start to bring me deals that are called pocket listings. So before they would bring it to the public markets and list it online, they would come to me first. That's really when the light bulb went off, and I started to see that wow, you could actually have or create a competitive advantage, have a competitive advantage in this asset class. And once I realized you can have a competitive advantage, then I started thinking that there might be a long-term play there for me to accumulate, multifamily and other types of real estate assets. Really, anything that I could get my hands on, where I can understand the cash flows, the value of their future cash flows, and discount them back appropriately.
Yeah, and so when you get into the discounting cash flows and some of the higher level formulations that really understand where you are today, I think that's fantastic. I appreciate you giving us some insight into that, which for some may be like the next level, like more advanced. What I want to make sure that the Going Long family, what you heard Ben say, and keep me honest here, Ben. In the beginning, you were just investing to be able to invest because you thought you could make more money than you put in. You didn't have a grand strategy, but over time, you started to realize these benefits and started to then devise a strategy around something that you had early success in. Was that accurate?
Yes, and once it really took, yeah.
Well,
Sorry.
So and the reason I want to really highlight that, and I appreciate you keeping it real, because sometimes you hear these stories of like, hey, listen, I had this grand strategy and it worked. And and the reason I'm saying that, Ben, is I started pretty much like you. Like, I didn't have this great masterful strategy of being able to do all this stuff. I just didn't want to put my money in the stock market anymore. I didn't want to keep it in the mattress. And when I started seeing, one of the things that came across my eyes at that point in time, we're talking over a decade ago now, was this real assets, this real estate. And then that opened my mind, not just to investing in real estate or all the different forms of real estate. I got into a couple of other ventures, but it at least got me started. And it was one of those things where I didn't have a master plan. And so it makes my heart happy when I hear somebody else say, well, I just kind of wanted to do this and I got started, and eventually I built the strategy around it. So thanks for keeping it real. That's why I wanted to just stop you there. But also, too, one of the things that I believe I heard you say as well is that you are asset agnostic, meaning that, well, real estate is something that's good. I think I heard you talk about tugboats. I think I heard you talk about coal mines. Like, where is it that you come up with this asset agnostic strategy, and what are some of the different things that you're looking for specifically? If you didn't hear you talk about it already, you've kind of given some like sprinkles, but talk to us about what are the things that help get your attention to say, this is where I want to make my next investment.
So when I was on the buy side working at the hedge funds, I didn't have a sector focus. A lot of times analysts had a very narrow sector focus. I was what's known as a generalist, in that I would look at every industry, regardless of whether it was metals and mining, or aviation, or plastics. Really more of a bottoms up strategy when really valuing purely on free cash flow potential, and then really making my way up from there. And obviously incorporating what's called a top down strategy when you look at the industry from a high level, and the growth rates, and supply and demand dynamics, and you bring that in too. But so because I was a generalist, and I was able to analyze really even like tribal casinos, for example, that are not even technically located on Native American or Native U.S. or on U.S. soil. I mean, they're sovereign entities. It really opened my eyes to how big the universe of prospective investments there is out there, and that you don't have to just limit yourself to one area. And I really brought that mentality with me when I started investing in real estate. So, for example, like I mentioned, coal mines and tugboats, basically what they have in common is that they have strong recurring cash flows with a very large amount of collateral coverage. And that's also what really got me into the outdoor hospitality industry or the luxury RV resort industry, because even though it's technically real estate, it might as well be considered a completely different industry. It's just, it's different in practically every way. But I believe that right now it represents one of the best opportunities in the entire real estate asset class.
Well, and that's when you see these different opportunities. One other question I'm sure people are thinking to themselves, he said collateral coverage. I know what that means. You know what that means, but break it down for someone who, when you say collateral coverage, what does that actually mean?
So basically, what that means in like a worst case scenario, if everything that can go wrong does go wrong, you have almost a backstop in that there is a hard, you're secured by you own a hard asset that has value. And even in a liquidation is sold, you are going to be able to recoup a majority, if not all, of your invested capital, despite the event that occurred.
I appreciate you clarifying that. So in case something goes wrong, you can sell the stuff that because it's actual real stuff, and you can create or recollect some potentially some of your capital. Talk to us a little bit more before we get into the going along final three. I know you've mentioned the luxury the luxury RV, the luxury outdoor. Talk to us a little bit about that. What caught your attention, and kind of where you're going to continue to focus your time and energy moving forward. And then we'll get into the going along final three.
Of course. So just to run out some fun facts that will make the opportunity kind of make a lot more sense is the average age of the RV owner in the United States now is down to 32 years old. Last year, over 460,000 new RVs were shipped, but only 15,000 new pads were built. So that's less than 3% of the demand. On top of that, the average age of the existing RV destination is about 40 to 45 years old and does not even offer safety or quiet, let alone Wi-Fi or cell service, or a resort style pool or pickleball courts or co-working space. So it just doesn't, it's not really, they're not keeping their mom and pop, 95% are owned by mom and pops operators that are very fatigued at this point, don't have the capital to invest to bring them up to the standards that the new millennial demographic of RV owner wants. And then why I got involved is COVID. And 60% of office workers are now permanently remote. So that's just catapulted the industry into the stratosphere, in that now you have all these people working remotely that are choosing experiential experiences over materialistic items. People, instead of buying a house, which they can't afford anymore, the average price of a house is gone from 280 to 370 in the past couple of years, and rates are at 7%. So a lot of millennials across the country are choosing to, quote unquote, put their equity on wheels and live a nomadic lifestyle. And basically, they are willing to pay a premium for a destination that offers the amenities that they want to be comfortable. And basically, so I'll let you take it from there.
No, yeah, I was just going to say, I mean, these are, really interesting and yeah, I mean, they're interesting stats when you talk about, the average 32 years old and 460,000 new RVs and 15,000 pads. Just that alone on supply and demand are some of the things that you start to think, okay, well, is this the type of opportunity you want to be in? And you talked about the team, you talked about locations and all these other different types of things, but it's really helpful to get some of that information. I know we're going to be able to provide more information and how they can learn directly from you, Ben, here momentarily, but we kind of got to get into the go along final three, man. And the thing is,
of course,
because you are our special guest, and I never ask the go along final three unless, well, our special guest says they're okay or they're ready. I figured I might as well ask you, are you ready?
Absolutely.
Well, you were born ready, man. I kind of get this feeling. Ben's got it cool, calm, and collected. He's got it all together. So here we go. So I like to bring things back to this side of the pond because I'm over here in Europe. although I'm originally from Columbus, Ohio, because I always want to know. And inquiring minds want to know as well, because they're listening, they're watching, they're running on the treadmill, and they're part of the conversation today. Help us understand, Ben, what is your favorite European city that you've either visited or is still on your bucket list to visit?
It would have to be Capri, off the coast, off the Amalfi Coast. It's one of the most beautiful, serene places I've ever been. And I just have a feeling of just ultimate serenity and just really being in my own zen, blocked off from the pressures of the world, and to the point where I seriously was talking to my wife and saying I don't want to leave and I want to move here. I want to give everything up and I don't want to leave. And I was dead serious.
That happens. And my first son, when he was born, I spent some time in Capri, and it was pretty amazing. Just on the front end of the summertime, so it's still great and fantastic. And you go to the little piazza there in the evenings, and everybody's out, and it's all glamorous and it's all cool, and these cliffs and cool. We'll talk about more of that later on. Nobody wants to. They don't want to hear the rest of the story, so plus they'll probably get jealous. Question number 2. And this is one of the things that I tend to see from people who are very successful. We don't normally get things right the first time, or you as someone who's very successful probably got some things wrong in the beginning, and it happens less as you gain more experience. So I don't want you to think about the mistake or the mistakes that you made, but really what were the lessons, or one specific lesson that you want to pay forward to the Going Long family, because you know by knowing this lesson, they're going to minimize the probability of that exact same thing happening, and you're going to help them get to the end goal much faster. What's one lesson you want to share with us today?
Yeah, one lesson I would definitely try to pay forward is be careful who you partner with on real estate deals, even especially if they're your friends, because a lot of unforeseen events happen, and if you are going to partner with anybody, let alone a best friend or a family member, it is absolutely imperative to hire the proper legal counsel and to put in a proper operating agreement with really the robust protections that are needed to really provide fair distribution of the assets in the case of a dissolution.
Yeah, seek appropriate legal counsel and make sure you have the right documentation in place, regardless of who's involved. So, I
guess another thing would also just be just in terms of always get a phase one. Just always get a phase one, even if there's one from 5 years. Just be over careful when it comes to environmental. Even if it's expensive, it takes a while. Just go above and beyond in overkill on environmental due diligence.
Okay, that makes sense. Well, appreciate that. And yes, you can over deliver here by adding more value. So you got 2 for the price of 1. Everybody on the Going Long family. And then listen, Ben, we got to wrap things up. But the last question number 3 of the Going Long final 3 is about feeding our brains with knowledge. So what is one book that you would recommend to the Going Long family?
Yeah, so the book that's probably been the most valuable to me over the past decade or more is it's called Investment Banking by Josh Pearl. It was my Bible when I was on the sell side and on the buy side, and it's still on my desk today. It's real, just in a very pragmatic way, discusses investment banking and just the overall investment process. It introduces the concept of leverage and how that increases returns. And it's an easy read, and it's one of those books that you're going to want to keep on your desk, and you'll be able to refer to it over and over again for decades to come.
All right, fantastic. So investment banking, we'll make sure to include that in the show notes. And I think to myself, man, these conversations, they literally fly by, Ben. Like every single conversation. Like today, I'm looking down, I'm like, oh my gosh, has the time gone by already? But I started thinking about you sharing with us from the very beginning, whether it's, finishing at Syracuse in 2011, or from there to be able to listen to different opportunities as you started out as an analyst in the financial services industry, but there were different things that you were always listening to as you were networking, as you were growing, as you were actually taking the information you were receiving, you were putting it into action. You even started listening to different strategies. There was so much, like there was one strategy for a company that you decided that you'd love that strategy so much that you left where you were, and you went to work with the person that you fell in love with their strategy. From there, I mean, I just think about you talking about, hey, listen, I took my bonus pay, which was sometimes, 3 to 5 to 7 times more than what I was actually getting my base pay. And I took that and I actually invested it in something that was going to provide me a return. I may not have even had this amazing strategy, but I knew that I wanted to get a certain outcome. So you took action, you were learning, you were understanding the leveraging your financial acumen, and then putting it in an asset that provided you with not only cash today, it provided you with some upside. It provided you with downside protection in case you needed to collateralize things, get rid of it, and even had some interesting tax benefits. And so as I think about this and I think about all of the things that you've done leading up to this point, even to what you're doing now at Redwood Capital Advisors, it makes me think, wow, there's so many things I want to ask you, but everybody here is going, just stop with all this stuff and just ask him the question. So I'm just going to ask you the question, Ben, because everybody wants to know. What's the best way for the Going Long family to find out more about you, more about what you have going on at Redwood Capital Advisors, et cetera? How can we find out about you?
Yeah, absolutely. Just our website, redwoodcapitaladvisors.com. There's a very easy call me section where you can book a call with my Calendly, and you can follow us on Instagram at Redwood Capital ADV. And we're on LinkedIn, and I'm on LinkedIn personally as well. And I love engaging in dialogue about real estate, regardless of how much experience people have. And I'm always happy to chat, whether you want to be an interested investor or not, or you're just interested in learning more about anything. I'm always happy to chat, and reach out to me anytime.
Okay, fantastic. Well, Ben, listen, on behalf of the entire Going Long family, I want to say thank you very much for deciding to invest your time with us today. Really appreciate it. Thank you very much.
Yeah, thanks so much for having me. I really appreciate it.
Yeah, it's my pleasure, Ben. So listen, if you can give me like 10, 15 seconds, I'll wrap up and I'll get you out of here. So Going Long family, look, I mean, Ben kept it like super real. Like he even told you he wanted to get started. He took action. He didn't have this massive strategy, but from there, he started seeing results. He built out, and he's now continuing to add more and more value, deep expertise in this area, in this field. Take today's conversation, listen to it again, share it with friends and family, and heck, go from theory to like the practical application that Ben was talking to you about. He's even made it really easy for you to follow him, to build a bridge, to connect with him. He even gave you his Calendly. So take him up on that. Take up advantage of that. But while you're here now going from theory to practice, I'll be here preparing for the very next conversation. So until then, go out and make it a great day. And thank you very much. Today's conversation was sponsored by the Billy Keels Advisory Program. If you're looking to make your 9-to-5 optional and need some help, just go to billykeels.com/advising. Once again, that's billykeels.com/advising.